Hello and welcome to another stock analysis on Stock Market Palantir. Don't forget to put your comments and subscribe. Okay, now let's go hear our analysts.
Welcome to the Stock Market Palantir. Today, we are going to talk about CMCSA. We're focusing on Comcast Corporation, ticker CMCSA, and really a fascinating situation in the market right now. Here's a company that is just, well, it's stuck. It's stubbornly hovering in the mid-$27 range. This is as of December 2025. Even though there's this massive strategic move on the horizon, the spinoff of Versant Media Group, set for January 2nd, 2026. The move is huge, but the price? It's just stagnant.
It is. And that stagnation is paired with, extreme volatility if you look at the technical flows. When you dig into the trade data, especially from early December, the signals are all over the place. We saw the off-exchange short volume ratios, and that's the percentage of shares shorted off-exchange, in dark pools. We saw them spike dramatically. We're talking 64.77% on December 1st and 64.04% just a few days later. These are extraordinary figures, and they tell me the market is completely divided, pricing two very, very different futures for Comcast.
Absolutely. And that intense institutional activity really brings us to the core question we need to wrestle with today. Is this price action, this high short volume, this lack of any real upward momentum, is it primarily a mechanical issue? A byproduct of a complex spin-off arbitrage that's just waiting for that distribution date to unlock value? Or does it reflect genuine, deep, unresolved fundamental concerns about the business itself? I'm going to argue that what we're seeing is almost entirely a mechanical process, one that's designed to finally resolve that long-standing conglomerate discount.
And I'll be arguing that while, yes, the mechanics are a factor, you can't ignore them, the price is anchored by very real fundamental risks. I'm talking specifically about core business challenges like broadband saturation and also the complex leveraged way Comcast has structured this Versant spinoff.
Well, when you look at Comcast today, trading at a price-to-earnings multiple of roughly 6.8 times, the evidence, to me, it just overwhelmingly points to a heavy conglomerate discount. That valuation is just screaming that the market cannot accurately price the high-growth connectivity assets and that massive Universal Parks division. Why? Because they're still bundled with these secularly declining media properties. The Versant spinoff is the solution. It's the direct, explicit solution to this problem. It's designed to cleanly carve out about $7 billion in shrinking revenue, freeing up the remaining, let's call it growth co, to finally get the higher PE multiple it deserves. We've seen credible analysts estimate the split will unlock something like 15 to 20% in hidden shareholder value.
Okay, I see that argument, but that analysis sort of assumes the discount is the main external problem. And I think that premise ignores the fundamental internal challenges. So while I'll grant you that technical arbitrage forces are at play, the price stagnation is, I believe, fundamentally anchored by significant risks that no amount of accounting cleanup can completely solve. The primary risk remains broadband saturation. The latest Q3 2025 results, they confirmed a really painful trend, declining revenue and significant net subscriber losses. It was 226,000 net losses in Q2 alone. And these losses are driven by fierce competition from fixed wireless access and, aggressive fiber overbuilders. If your core profit engine is sputtering, the whole re-rating thesis is, well, it's built on pretty shaky ground.
But that's where understanding the mechanics becomes so essential. The high short volume in the dark pools it's consistently misunderstood by retail commentary. It is not bearishness. It's not directional distress. It is a technical prerequisite for event-driven arbitrage. You have funds that are buying the undervalued CMCSA parent stock and, at the same time, shorting the provisional stock of the Versant entity, the when-issued security, VSN-TV. This just hedges their exposure while they wait to capture the value spread when the distribution happens. And the most compelling evidence for this is the cost of borrowing. It is negligible. It's holding steady between 0.25 and 0.29%. If this were a traditional short raid, a bet on the company's failure, that borrow fee would be spiking into the stratosphere.
Mm-hmm. The low borrow fee is certainly a strong counterpoint to the idea of a distressed short, I'll give you that. However, just because it's not directional distress doesn't mean it signals a guaranteed value creation. The fact is, the spin-off itself is just inherently complicated. VSNTV Group, VSNTV, it's going to raise about $3.5 billion in new debt and then transfer $2.25 billion in cash back to CMCSA. This is a classic leveraged spin-off. You're burdening the declining media assets with serious debt, you're basically transferring future liability, and the market is pricing in the uncertainty that comes with managing a debt-laden, melting ice cube.
Okay, let's address that perceived fundamental weakness, the broadband net adds, by putting it in context of the frankly generational assets the market is ignoring. The narrative is obsessing over noisy quarter-to-quarter subscriber numbers, and it's missing the absolutely massive, tangible, free cash flow expansion coming from the Universal Parks division. I'm talking, of course, about the Epic Universe theme park. That park's opening represents a profound free cash flow inflection point in 2026 and beyond. In Q3 alone, the parks division generated $2.7 billion in revenue, with industry-leading margins. This cash flow engine is so enormous that it will overwhelmingly dwarf any short-term volatility in broadband. This is the growth story that the conglomerate discount is currently burying.
I get the enthusiasm for the parks, I really do, but have you considered that the positive FCF from the parks is maybe just acting as a required offset? It's offsetting the unavoidable secular decline in linear TV, and more critically, it's offsetting the ongoing structural risk in broadband. Management's own behavior suggests they're managing maturity, not unlocking pure growth. Think about it. They haven't split the stock since 2017. That's a classic move that signals growth confidence. Instead, they pivoted entirely to aggressive value realization through buybacks and dividends. That is a strategy for a mature business, not one that's poised for significant growth in its core markets.
I see that completely differently. I think that management shift is precisely what strengthens the bull case. They are acting rationally in the face of a mispriced market. At 6.8 times earnings, every single dollar they spend on share buybacks is intensely accretive to earnings per share, and they have a substantial $15 billion buyback authorization. If the stock is undervalued by 15%, that $15 billion represents one of the most efficient uses of capital in the entire market. It provides a massive self-reinforcing floor under the stock price, and it proves that management recognizes and is actively capitalizing on this valuation disconnect.
Okay, but that brings us right back to the institutional flows. The question isn't whether buybacks are mathematically a good deal. The question is whether the market believes in the degree of the value unlock. And while the low borrow fee prevents us from calling it a short raid, the immense institutional hedging activity, that massive off-exchange shorting, it signals caution to me, not conviction. VSNTV when issued trading starts mid-December. Institutions are very carefully repositioning their exposure. They're not aggressively buying the parent CMCSA stock directionally. If a 15 to 20% unlock was a sure thing, the buying pressure on CMCSA would overwhelm the hedging. The fact that the stock is stuck in this range suggests the outcome is highly unclear. And, that's a view echoed by divided street analysts, like the Oppenheimer downgrade that specifically cited growth concerns.
That's an interesting take on the technical picture, but I would frame it differently. The low borrow fee, coupled with the fact that Comcast has never done a reverse split, which confirms its robust blue-chip status, that doesn't suggest uncertainty to me. It simply confirms that this high short interest is the operational cost of doing business for specialist funds. They are positioning for an arbitrage opportunity that exists precisely because the current valuation is mathematically too cheap. It's a technical necessity, not an expression of fundamental skepticism. And we have to remember the noise in the system. The retail skepticism you mentioned, often fueled by, legitimate customer frustration with Xfinity service, that often provides a very reliable contrarian buy signal for the sophisticated investor who understands the long-term strategic value.
But that perspective just seems to ignore the structural baggage being created. Let's really focus on the Versant spin-off structure in the liabilities. It is very hard to call this a clean unlock when you examine the debt extraction.
But the debt loading on Versant is highly strategic. It achieves the core goal, which is cleaning up the parent balance sheet. By extracting that $2.25 billion cash dividend before the spin, CMCSA dramatically strengthens its ability to execute that massive $15 billion buyback. It's a targeted use of capital. And think about the strategic brand cleanup. Isolating MSNBC, rebranded as MS Now, it protects the core NBC brand from political polarization. That's a subtle but crucial move that improves future advertiser appeal for the remaining growth co. This is intelligent financial engineering and strategic de-risking, plain and simple.
I'm sorry. I'm just not convinced that this extraction is purely beneficial. The transfer of $2.25 billion in cash out and saddling the new Versant entity with over $3 billion in debt, it leaves VSN TV highly vulnerable. Combined with its declining revenue, VSN TV will likely trade at a deeply depressed multiple, maybe 4 to 5 times EBITDA. The market frequently penalizes the parent company when it offloads debt onto the spinoff. It sees it as a move to extract immediate value at the expense of the new entity's future. And that perception, that cynicism, can create a significant governance discount that just eats into the value unlock you're anticipating.
But the market has to price the relative size of these issues. The complexity of Versant is a known quantity. And relative to the overall size and cash generation of a $27 stock, these issues are minimal. The connectivity and parks businesses generate enormous free cash flow. The strategic value of creating two focused companies, one a high-growth connectivity play, the other a managed yield play, will ultimately overcome these technical arguments. The low valuation suppressing CMCSA is a mechanical artifact. It's an artifact that is scheduled to dissolve right after January 2nd, 2026.
I agree the arbitrage opportunity is tangible, but investors simply cannot afford to ignore the structural shift happening in the core broadband market. The financial risks embedded in Versant's capital structure will likely weigh on the broader perception of management. The true re-rating of the remaining Comcast entity will depend less on the spin-off mechanics and more on management providing hard proof demonstrating sustainable stabilization or even renewed growth in those critical broadband subscriber numbers. Without that proof, the market is going to hesitate to grant that higher multiple you project.
And I maintain that the proof will be in the overwhelming cash flow from the parks division and the enhanced efficiency from the cleaned-up balance sheet, allowing for those massive buybacks to deliver immediate, realized EPS accretion.
The challenge remains, though. Can the efficiency gains outrun the structural headwinds facing the legacy business?
Indeed, the market has presented us with a very intriguing situation where the technical pressure and the fundamental risks appear to be balanced, almost precariously at this current price range.
Right. The uncertainty around the January 2nd distribution date means that both the technical arbitrage positioning and the long-term fundamental risks are equally valid components driving the current $27 valuation. The final true valuation will be decided by the market's behavior right after the spin.
We examined whether the recent price stagnation in CMCSA is primarily due to mechanical arbitrage positioning ahead of the Versant spinoff, or if it is fundamentally anchored by unresolved risks in the broadband market and the leveraged debt structure of the spun-off entity.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.